amongst the sort of voices on the street, you were one of the very earliest that we noticed who said, we're not going to get cuts this year. Has anything changed in your view as we've heard? Are you pushing out maybe your outlook for cuts even more?
No, I still think that they will not cut rates this year. The reason is that after several years of the Fed saying interest rates are going up, 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 in December of last year, they changed their tone, and now, including even yesterday, we are now talking about rate cuts as the next move. So when the Fed began to change their tone, and instead of talking about interest rates going up, but now talk about interest rates going down, that unleashed a very significant amount of activity in capital markets. The S&P 500, where market cap is around 40 trillion, is up about 20% since the November FOMC meeting. That's about $8 trillion added in market value just because of the stock market going up. Remember, consumer spending last year was 19 trillion. So that means that roughly half of consumption has been added to household balance sheets. So with that backdrop, we changed our view when we saw that the tailwind from the gains in the stock market, from tighter credit spreads, from, generally speaking, lower interest rates, this has all been helping the economy. So we still think that the economy will be doing well for the next several quarters.
But does that also imply that the Fed made a mistake in its signaling? Because even though it has not yet cut rates, the signaling that it was going to maybe prolonged the inflation cycle?
That's exactly what I think is most important about this discussion. I don't think this was their intention. I think that they just looked very innocently at the dual mandate that they have been given by Congress. Inflation should be 2%. We should have full employment. And they said, well, inflation is coming down. We're at full employment, so maybe we don't need to have interest rates so high anymore. That's why they began to talk about interest rates going down. But what they didn't recognize and maybe only realized later was that when you, after several years of having said interest rates are going up, 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 you did not have many IPOs, you did not have much M&A activity, you didn't have much issuance in IG, high yields. So as a result of that, that has now been unleashed, and that is, as we speak, creating much more activity in capital markets, much more consumer spending. That's why non-farm payrolls has been strong for the last 3 months. Inflation is reaccelerating. The consumer is still strong because we now have a significant tailwind because of that signal change. So I don't think this was their intention. I think this is just what happened, that it unleashed that significant tailwind to the economy that then is creating this risk of inflation moving higher again.
I'm interested, Torsten, then. So you don't see cuts this year. What is kind of the probabilities you put on a rate hike? Because yesterday Jay Powell says unlikely, but what do you see? What are the probabilities there?
So the Fed Fund futures market is saying there's a 20% chance of a rate hike this year. I think that's a reasonable number. So 80% that we will stay here, or some people's scenario go lower, or 20% risk that we'll go higher. But I still think that we should definitely take 1 month at a time. The data tomorrow will be extremely important because this will be setting the stage for how we think about, will rate cuts come sooner, or might we have interest rates higher for longer? Because remember, interest rates higher for longer is not good for small cap. 40% of the Russell 2000 have negative earnings. And if you already have no earnings and you have higher and higher debt expenses, that runs the risk, of course, that small cap companies might be more under pressure. So there's a very important difference between the S&P and the Russell 2000 when you think about this implication of interest rates staying higher for longer.
And of course, the data you're referring to tomorrow is the jobs report. Do you think we will get any signs there that show that maybe unemployment is ticking up or wages are moderating to any degree?
Well, we saw today, as you also covered, of course, so well here, that the jobless claims numbers are still very low at around 200,000. In other words, there's still a limited amount of people who filed for unemployment claims last week for the first time. If you look at the consensus expectation is that job growth in the month of April will be 240,000. The unemployment rate expected to move sideways at 3.8. So in that sense, if we're waiting for a slowdown to get the Fed to begin to cut rates, that's not coming tomorrow. So that's why my best guess still is that we will still have to wait a while before the data begins to slow down, and therefore rates higher for longer continues to create particularly challenging environment on your screen of companies for those firms that have high leverage, that have low coverage ratios, meaning low earnings relative to interest expenses. So that means that the most highly levered companies, both in credit and in equity, are probably continue to be more challenged by interest rates simply not coming down.
I have kind of a broader question to you also, Torsten, just as someone who's watched the Fed for so long. You look at our central bankers. I mean, in 2021, they talked about transitory inflation. They were wrong. I think it's fair to say earlier this year, FOMC officials sounding pretty positive about the trajectory of inflation. Now, not so much. I'm just interested in the confidence you have in the Fed, the credibility.
No, I'm smiling here because if you go back, the Fed began with Ben Bernanke to produce their interest rate forecast in 2012. And if you go back and ask the question, how did it go with that forecast process? How successful were they? And the answer is they were were basically wrong 90% of the time. They did not predict interest rates the right way. They were just saying, well, this is what we think will happen. Ooh, that's not what happens. Okay, then we'll do something else. So that's why when now they say, as we speak, their view is we will get 3 cuts this year. We might as well have a debate about, well, that's open for discussion because they have not been right for a very, very long time. The market hasn't been right either, but it's just to say the high conviction that we all have, and when we debate between FOMC meetings and we put so much emphasis on what they're saying, we should all, including they, be humble here that it is just a really difficult job for them. It's difficult for us in markets. So therefore, hanging our hats on their view, oh, we're getting 3 cuts this year, it could as well be correct that we may get no cuts.
And of course, a lot is riding on, on them trying to grapple with this and come up with the right answer. And the other thing I wanted to ask you about is you say, as you look at the screen of companies, those that have high leverage are going to still have to deal with this. We also seem to be maybe starting to see some erosion of consumer spending, at least if you look on the micro level and look at some of the company reports we've been getting.
Yeah.
Do you think that that's the case? And how worried are you about that? Do you think that's going to get worse?
I do think that this conversation about a K-shaped recovery where the lower income consumers are getting hit harder and harder. And why are they getting hit harder and harder? Because they generally tend to have more debt. That also happens to be younger households. When you're young, you have more debt on your house, you have more debt on your car, more debt on your credit card. So when interest rates go up, it's not surprising that younger and lower income households are actually hit harder as a result of the Fed raising rates. Whereas the upper leg of the K is people who have assets. If you have stocks, obviously have done quite well. Houses have done quite well. If you own fixed income, your cash flow in fixed income is probably the best that it's been in decades because the yield that you have both on normal rates, on private credit, on, broadly speaking, fixed income is just so high that this is exactly also supporting your balance sheet. And this continued move in the K where some households are experiencing more distress as a result of the Fed having raised rates and others are still experiencing stock prices going up and cash flow being good. I think that we will continue to see that development, which is exactly to your question that the names that have been reporting for the last week or so have exactly been names that are catering to the lower-end income consumers and income groups who are more and more under pressure. McDonald's, others, where you have seen exactly these anecdotes that there is more selectiveness among consumers in terms of what they do. So the short answer to your question is, in the aggregate, consumption is actually still looking okay, but there is underneath the data some very important differences in some groups are doing better than others.
I'm interested, Torsten, you talk about those younger Americans and they're going to be less likely to own a home as well. We're talking to Zillow's CFO later in the show. What is your outlook for the housing market?
Well, the challenge, of course, was, and I know it gets slightly complicated when you think about what the Fed has been doing, but when interest rates went up, that meant that more and more people didn't move because they wanted to keep their low interest rate, their mortgage rate at 3%, and they didn't want to reset and get a new one at 6, 7, 8%. The consequence of that was that the inventory and the number of homes for sale, and you should ask the Zillow person you're going to talk to about this, basically came down dramatically. And when the inventory came down and we all came out of COVID and demand went up, then home prices actually have been going up. This week we got Case-Shiller now up 7%. Remember, in the CPI index, housing makes up about 40% of the basket. So in inflation, housing is really important because for the average consumer, 40% of their consumption goes towards paying either their mortgage or their rent. That means that in somewhat perverse way, you have had that the Fed hiking rates has lowered the inventory of homes, which has actually pushed out home prices, which is actually now pushing up inflation. So that's why my textbook in economics would have said that that's not what should have happened. But that is exactly, unfortunately for the Fed, what happened, that we're now wrestling with maybe inflation could actually take even longer. And maybe therefore the Fed may have, that's not our expectation, but to keep rates higher for longer, and the worst case, hike for more, to exactly prevent inflation from beginning to move higher again.
So put all this together for us. I mean, we've talked a lot about what this all means for the economy. What could it mean for the markets this year?
I think if I just think about this very simply, so interest rates higher means that if we are a firm, we will have higher debt servicing cost. Higher debt servicing cost means that the stock price should go down. So on its own, when interest rates go up and debt servicing costs go up, that should be negative for equities. But the important thing here is that interest rates are going up because earnings are good. So if you at the same time have that GDP is good, earnings is good, the consumer is good in aggregate, well, maybe that tells me that, well, if everything is good on the earnings side, well, stocks should then be going up. So I would say that ultimately, if we still have a few more quarters, which would be my expectation, where growth is going to be strong, earnings is going to be good, the consumer seems to be fine, well, then maybe the market, credit, IG, high yield loans, capital markets will still get a lift from the economy actually still doing well. And unfortunately for the Fed, that also means that inflation is a risk of also getting a lift. So therefore, the effect of interest rates being higher for longer, meaning I have higher debt servicing cost, is being overwhelmed by the fact that earnings are still strong. So that would argue ultimately for the market, S&P 500, probably still doing okay. Yield levels being very higher, and of course in our world that means private credit yields continue to look very attractive because the Fed now has to keep yields higher for potentially a good deal longer than what they thought just a few months ago.
Torsten, we always love having you on set.
So great to
It
have
is
you
great.
here.
Thank you for helping us
thanks
kick off
coming
the show.
Anytime.
Appreciate it.
Anytime.